So how do you evaluate a multifamily deal? You know, I know it seems a little intimidating, and I'm going to give you some great tools today to help you with that. So if you don't know me, my name is Khleif, and I host the Lifetime Cash Flow Through Real Estate Investing podcast, which I'm blessed to say is the largest commercial real estate podcast in the world now, with over 14 billion downloads. And I'm also author of #1 best-selling book, How to Create Lifetime Cash Flow Through Multifamily Properties. So I'm going to show you today how you normalize your expenses. So what does this mean? Well, you're going to get a broker's offering memorandum. If you call on a broker and say, hey, send me information on that property, you'll get what's called an OM, a broker's offering memorandum, and it's going to have typically a T12, a trailing 12 months income and expenses. Now I want to say this to you, okay? Most of the time, that stuff is toilet paper, okay? Now, some brokers know what they're doing, a lot don't. And so that's why you have to do what's called normalizing the expenses. You have to go line by line and make your own determinations on what you should be allocating and projecting for these different line items when you do an analysis of a property, right? So let's get into it. So like I said, you'll get a T12. Sometimes you'll get maybe a T6. That'd be the last 6 months, T3, the last 3 months. But you want a T12 because you want to know if they've just filled up that property in the last 3 months, for example. So you really want to operate from a T12. So let's get into it. All right, so this is called normalizing expenses. Now you are also going to normalize the income, okay? So what you're going to do is you're going to look at what competing properties are renting for, right? Now you want to make sure they're truly competitive, okay? You want to make sure they're the same age approximately, same general area, but really important that they have the same amenities, okay, and the same features. Because for example, I don't know if you know what wholesaling is, but I've got a friend of a friend that could have wholesaled a deal and made $1 million. Now I've got students that have done that. I've got 2 that made over $1 million, and I've got about a dozen that made over 100,000 wholesaling properties. But this guy messed up and he lost this opportunity because he didn't compare apples to apples. You've got to make sure you're doing apples to apples. So what happened with that guy was he was looking at a property where the owner paid all the utilities, and he compared it to a property where the tenants paid all the utilities. It was about $150 a month difference, and that's significant if as you get into larger properties. So anyway, let's get into it. You've got your potential gross income. Now this is what the property should make if it's full and if you're getting the top rent, the market rent for the property, and it's all possible income, okay? And what we've done here is I've broken it into under 75 units and over 75 units as we do this analysis, okay? Because it's a little different on some of the expense line items what it should be. Now it's actually even different on the income as well, because on a smaller property, you're going to deduct 5 to 10% of the gross income for things like vacancy, concession, bad debt, things like that. Now on a larger property, it's only going to be 3 to 10%, okay? And so you come up with what's called the effective gross income, okay? And now you will also have other income like laundry, like concession stand, like late fees, pet rent, utility rent, things of that nature will all come into other income. So you'll add that in as well. So now let's get into the expenses. So the first thing is administrative. Now on a smaller property, you're not going to likely have an office, okay? So there's not going to be as many, little to none. Now if there is an office of some sort, then that's what would be applicable there. On a larger property, you're going to have a leasing office, and it can be quite costly. Like we're buying an asset right now, 145 units, got a leasing office, pool, everything else, and that cost is about $250 a unit per year. That's an annual number, okay? Now, as you're going through this, if you've got questions, drop them in. We pay close attention to those questions, and we'll answer them for you, okay? All right, so that's on administrative. Now, on contract services, this is one you can come pretty close on even without guessing, because you can go have people bid it. You want to look at, does it need landscaping? If it's in Arizona, maybe it's just rock and some cactuses, no big deal. But if if it's got a pool, there's going to be an expense for that, taking care of that. Pest control down here in the south, snow removal up north. And so you're going to have to allocate for that. But this is not really guesswork, because you can have contractors drive by and say, give me a rough bid. So for both situations, it's going to be $150 to $350 per unit. Now I know that's a big range, but again, you're going to be able to come pretty close on that. But you need to make sure that you allocate for everything. Every possible thing you're going to hire a contractor for. So again, the big ones are typically landscaping, pool, pest control, snow removal, things of that nature. Those are the big ones. Okay, then you've got insurance. Now this is one of the biggest expenses that you have to make sure you get right. And there's no reason for you to mess this up because you can get bids on this, okay? But I gotta tell you, it has gone through the roof lately because of the storms. We've got assets in Texas where it's over $500 per unit per year, and it used to be half that, okay? Now they're saying it's even more than that. We're bidding out a property right now, but it's definitely property by property. Its age is really relevant for this. Previous loss history is really relevant for this. But you can absolutely get bids for this, and you should. You should contact a national insurance broker, one that does business nationally, and have them bid it. They don't have to see it to do it. They can get all the information from you. All right, so now marketing and advertising. This is where newbies make a mistake. They think if they buy a smaller property, they're not going to have marketing and advertising, but you absolutely are, okay? So, you know, I would encourage you to have at least $50 to $100 allocated for advertising. Again, this is an annual number. On a larger property, you're going to have more. You might have your property in apartments.com. That's not cheap. And there's other websites that you would advertise it in. But don't forget this line item. It's super important. Now, if you see nothing on a broker's OM for this, you know, I'm going to call BS, okay? Because I promise you that they're paying some money to market that property. So this is why you have to do this, and you're going to see some really low numbers on some of this stuff when you get a T12. Now, sometimes what'll happen, just so you know, this is really important. Sometimes you'll have an owner that has multiple properties, and they will put their expenses on other properties if they know they're going to sell one, because any increase to that net income is an exponential increase to the value. Let me give you an example of this. It's called the NOI, the net operating income. Any increase to that is about $17 to $20 to 1. So here's an example. We've got an asset in San Antonio, Texas, and we numbered all the parking places, okay? And then we said, hey, Mr. or Mrs. Tenant, if you'd like your own parking place right in front of your unit, it's $25 a month. We'll reserve it for you. We had 100 people take us up on it. $125 a month. Do you know what that did to value? $800,000 increase in value. Yeah, baby. Okay, so any increase to the NOI is an exponential increase to the value. So you got to make sure you get all the expenses, okay? So, and then there are sellers that will pull that crap where they'll take stuff and they won't show it on the T12. They'll assign it to other properties knowing that any increase gives them $17 to $20 per one, okay? All right, management fee. This is another area that newbies screw up, okay? And they misunderstand, okay? So on a smaller property, you're gonna have a higher management fee. Why? Because let's say you've got a 20 unit. You're not gonna have an on-site manager, so all of the leasing has to be done by the management company staff, okay? Let's say you know, you're doing maintenance. You're not going to have a maintenance man on site, and you're not going to have a manager to coordinate that maintenance. So they have to coordinate that maintenance, send the maintenance person out, or send a contractor out. Again, that's why, you know, very often under 20 units, you could pay 8 to 10%, okay? That's not uncommon at all. Now, with a larger property, you're going to have an on-site staff, okay? And so like that San Antonio asset, we're at 3%. We have a Dallas asset under contract right now. Our management fee is going to be 3%. Now, it's a percent of the gross income, just so you know. Now, here's another tip. If you've got a smaller asset, sometimes you'll see where the management company, these small management companies are really tough to work with. I'm just going to tell you, a lot of them are inexperienced. It's like some real estate broker said, hey, I'll be a property manager. They're not that good. And so you're going to, unfortunately, probably go through a few with a real small asset, especially if you're in like the 2 to 10 unit range, okay? But the two things to remember. Number one is maintenance is a real profit center for a small management company. They'll hire some kid at $15 an hour and rent them out to you at $100 an hour to do painting or whatever. So you really want to pay attention to that. But here's the thing to remember, okay? On a larger property, you'll have on-site people that will handle all of these things, which is why, again, you're going to have a much lower maintenance fee for a smaller property than you do for a larger. Oh, this is the other thing I wanted to mention. Okay, some of these smaller management companies will charge you a percent of the first month's rent when they lease a new property. Big mistake, okay? Why? Because it's a conflict of interest. Every time they release the property, they make money, and your biggest expense is tenant turnover. And so you want to make sure that instead of that bonus structure, you bonus them for renewals. Tenant stays in, yeah, I'll pay you a renewal fee, not a fee for new rentals. Super important, okay? All right, now this is another big newbie mistake, underestimating repairs and maintenance. Guys, if you've got a older property, you're going to have more maintenance. It's going to cost more. And if you've got like, if you know my story, I lost $50 million in 2008 and 9, and it was because I had 800 houses, okay, and they were C-class houses. 2 hours south of me, 2 hours north of me, everywhere in between here. And it was the houses that pulled me down because they were C-class. It's a tougher demographic. They're harder on the properties. They were older properties. Lots of maintenance. It was the maintenance that killed me. So do not be aggressive on your maintenance estimates. Now, guys, we are heading into a recession, could be a depression. In fact, I think it's going to be. Now, not to scare you, I'm telling you to get excited. But the point in that is there's going to be incredible opportunities. So you want to get up to speed on this stuff as fast as you can. By the way, I've got a boot camp coming up. I always have a boot camp coming up. I don't know when this will air, but I've got a virtual one coming up October 15th and 16th. If you go to rodsbootcamp.com, it's $97 and there's a bunch of bonuses. Kind of a no-brainer. I don't sell anything there, so make sure that you check that out. Actually, I might even have a slide on that. I got ahead of myself. But anyway, okay, so you should calculate $500 to $800 a unit. Now, if it's a really old property or it's a C minus asset, you might want to go to $1,100 here, okay? You might want to go to $1,100 on a smaller asset. Not on a big one, but on the smaller one for sure. So don't be aggressive there. All right, property taxes. This is the single biggest expense, okay? Single biggest expense. Now, every geographic market is different on this. So you need to find out how they assess taxes in wherever you're buying. Because sometimes it's assessed every couple of years. Like that Tennessee asset we're buying, it's not going to be reassessed for 2 or 3 years. So we don't have to adjust the tax number. But if it's adjusted every time a sale happens, you need to know that because it could double. So whatever the owner shows you as taxes, don't assume that's what it's going to be. It's not going to be. It's going to be more than that. So you need to check it out, find out. Very often it's 75 to 82% of the purchase price times what's called the millage rate. Okay? And that's on both size properties. Now, but again, you need to find out how it works in your market. Check with brokers, property managers, other investors to find out so that you don't mess this one up because this is the largest expense you're going to see on an asset, okay? Now, this one confuses newbies, salaries, okay? So on a smaller property, you're not going to have people working at the asset. You're not going to have salaries, okay? But on a larger one, you should allocate $1,000 to $1,500 a unit per year. What does that mean? You're going to have a manager on site. And like this 145 unit asset we're buying right now in Nashville, there's a manager, assistant manager, leasing agent, there's a maintenance supervisor and 2 maintenance techs, okay? So all of those are salaries, and the misconception is a lot of people think that comes out of the management fee. No, it doesn't. You're paying those salaries and management fees to manage those people, okay? So don't make that mistake. You're going to have to allocate for salaries on a larger asset, okay? Now, a really good rough rule of thumb on a decent asset is about $1,100 per year per unit. But it can go as high as $1,500 and it can go a little below $1,000, but not much. So that's salaries. Now, utilities, okay? Even if the tenant is paying all the utilities, you're still going to have some utility expenses. You've got lights shining on the complex. Maybe you've got a pool. That costs money. Maybe you've got a clubhouse, okay? So it's going to depend based on what the amenities are, what you should be paying, what the house or the property should be paying for utilities, right? Now, on a larger community, I would estimate at least $500, well, really not at least, $500 a unit per year on a larger property for utilities. But again, you can find this out. This is typically accessible by, unless the owner really can't BS this because you're going to get the utility bills. So you should, just get the real numbers to figure out what it is. Now, very often you'll see a community where the utilities are billed back to the tenant. Here's a really important piece. Never overbill on that. It's actually a felony, okay? You got to make sure it's dollar for dollar, and you've got to make sure that you're paying for any of the stuff you should be paying for. Super important. Don't play around with that. Now, large management companies will handle this for you. It's called RUBS, Ratio Utility Billing System, where it gets billed back to the tenants, and there are companies that do it as well. I would not recommend you do it yourself. Okay, and then the last thing here is most lenders know that things break down on properties like new roofs needed, parking lots redone, HVAC units, chillers, boilers, things like that. And so most lenders will make you put up a reserve per year per unit. Now, this is your money, but it can be as much as $250 to $350 per unit per year. It's not insignificant, but again, it's your money. When one of these things goes out, you can take that money and pay to repair it, okay? But you need to allocate that when you're doing your financial analysis, right? So it's called lender reserves. Now, by the way, you can negotiate this number. If they give you a high number and you know that they've just done a bunch of work there, or you're going to do a bunch of work there, like you're replacing all the HVAC, for example, you can absolutely negotiate that. So just keep that in mind. So that's how. Now, here's you can't see it down here at the bottom, but it says the overall rule of thumb is that the expense ratio should be around 50%. That's a really good average. So you've got all your income, less all your expenses, does not include debt, by the way, less all your expenses should be about 50%. Okay, so keep that in mind. If you see somebody and it shows 35%, unless that property is brand new, even then that's low. Unless that property is brand new, it's complete, you know what, BS, okay? So keep that in mind. Now, as I said a minute ago, incredible opportunities coming, okay? And so you got to pick your vehicle. You got to decide, what am I going to do to capitalize on what's coming, okay? Because everything's going on sale. And some people are saying it could be the greatest transfer of wealth in history. And so, you know, I've got a boot camp coming up. It's, oops, got all my crap on there still. Okay, so I've got a boot camp coming up. It's 2 days virtual. It's October 15th and 16th. Now, if it's past October 15th and 16th when you're watching this, go to the website because it'll be whatever's next for the boot camp. Okay, go to Rod's, oh, you can't even see it here. Go to rodsbootcamp.com. Here, hold on. Go to rodsbootcamp.com and it's not, by the way, I don't sell anything there, okay? You can come for $97, okay? $97, 2 days of training, nothing being sold. But here's the point. If you're going to do multifamily, get your butt there, okay? If you're going to do something else, single family, go find a single family thought leader to train you on that. If you're going to go buy businesses, go do that, but do it right now. Because if you're trying to learn this business in the thick of this recession or depression, it's going to be too late because you got to build relationships. You need to know how to underwrite deals and all of that. Now, I go through everything in this thing. I go through finding deals, raising all the money you need for your deals, building your team, fully evaluating and doing the due diligence on deals, financing them, teach you about syndication, joint ventures, property management, you name it. And again, nothing being sold. You also get some awesome bonuses. You get my document library, you get a deal analyzer software. Those two things alone are worth 10 times the $97. And listen, if you come and you don't absolutely freaking love the event, let me know, I'll give you your money back. I don't mean like it, I mean love it, okay? When you go to this website, go to the bottom and see the hundreds of testimonials that people have said about this experience. Because I keep it really interesting too. There's a reason my students are so incredibly successful. I spend a lot of time on mindset and psychology because so you actually take action with what you learn. And then what's coming? Okay, there's going to be a lot of fear. Okay, a lot of, the news are going to paint things to be really ugly. And so your focus is super important, and I help you with that at this boot camp. So again, I don't care if you learn from me, but the bottom line is you need to learn right now so you don't miss out on this incredible opportunity that's coming. I hope I see you there.